Did you know there's a hidden force that could be silently draining your bank account, possibly for the rest of your life? What if I told you that a simple $5,000 debt could balloon into over $11,000, even if you never miss a single payment? It sounds crazy, but it's the reality for millions. This isn't a scam or some far-fetched story. It's the power of interest. And today, we're going to expose it. Welcome back to our channel, your guide on the path to financial independence. We're all about real, practical tips that actually work. This is the 4th episode in our 30-part series, and we're still laying down the essential foundations. Why? Because without a solid understanding of these basics, building real wealth is nearly impossible. Today, we're tackling the #1 enemy of your financial freedom: debt interest. Let's start with a term you've probably seen 100 times, but maybe never fully understood. APR. What is it, really? APR stands for annual percentage rate. Think of it as the yearly cost of borrowing money. When you see a credit card with a 22% APR, that means you're repaying 22% of your balance over a year just for the privilege of borrowing. It's the price tag on your debt. But here's where it gets tricky. That percentage isn't just a simple fee. It's the fuel for something far more powerful and dangerous: compound interest. So, what's the difference between simple and compound interest? Imagine you borrow $1,000 with 10% simple interest for a year. At the end of the year, you'd owe the original $1,000 plus $100 in interest. Simple, right? Now, let's see what happens with compound interest. It's often called interest on interest. With debt, this works against you. If you have that same $1,000 debt at 10% APR, and the interest is compounded monthly, have you ever wondered why credit card companies seem so happy when you only make the minimum payment? It's not because they're being nice, it's because the minimum payment is their golden ticket. Making only the minimum payment is a trap designed to keep you in debt for as long as possible. Most of that tiny payment goes directly to covering the interest you just accumulated, with only a few dollars, if any, going toward the actual money you borrowed. This is how a small debt can haunt you for decades. You're essentially running on a treadmill, working hard to make payments, but the debt isn't going anywhere. It's a cycle that keeps you poor, making the banks richer with every payment. Let's look at a real-world example that will truly shock you. Imagine you have a $5,000 balance on a credit card with a 22% APR. That's a pretty average rate these days. By the way, the minimum payment might be around $150 if you only pay that minimum amount each month. How long do you think it would take to pay it off? 5 years? 10? Try over 16 years. 2. Recent data shows that the average credit card debt per household in the United States is climbing into the thousands of dollars, with interest rates at near-record highs. This isn't just an individual problem. It's a massive societal issue. Millions of people are caught in this web, unable to save, invest, or get ahead because a huge chunk of their income is being eaten by interest. It's a silent wealth killer. So, what can you do? The first step is awareness. You have to know your enemy. Go, look at your credit card statements right now. Find the APR. Look at the little box that shows how long it will take to pay off your debt if you only make minimum payments. Let that number sink in. Let it scare you a little bit. That fear is a powerful motivator. The next step is to break the cycle. Yes, to start paying more than the minimum, as much as you possibly can. Every extra dollar you pay above the minimum goes directly to the principal, the actual money you borrowed. This does 2 amazing things. It reduces the balance faster, and it reduces the amount of interest you'll be charged in the future. It's like punching the debt snowball and breaking off a huge chunk. If you have multiple debts, you might wonder where to start. There are two popular strategies: the debt snowball and the debt avalanche. With the snowball, you focus on paying off your smallest debt first, regardless of the interest rate. The psychological win of clearing a debt gives you momentum to tackle the next one. With the avalanche method, you focus on paying off the debt with the highest interest rate first. Mathematically, this saves you the most money in the long run. Which one is better? The one you'll actually stick with. Understanding interest isn't just about math. It's about freedom. It's about deciding that your hard-earned money belongs to you, not to a credit card company. It's about taking back control of your financial future. This knowledge is the key to unlocking the chains of debt. This is a critical foundation for everything else we're going to talk about in this series: SEMing, investing, building wealth. None of it matters if you have a high-interest debt monster eating up all your progress. You have to slay the dragon before you can claim the treasure. Think about what you could do with the thousands of dollars you might be giving away in interest. You could invest it, save for a down payment on a house, take a dream vacation, too, or simply have the peace of mind that comes with being debt-free. That future is possible, but it starts with this first, crucial step. Thank you for joining me today to uncover this hidden enemy. I hope this has opened your eyes to the true cost of debt. If you found this helpful, please give this video a like and subscribe to the channel. So you don't miss the rest of our 30-episode journey to financial independence. Share this with someone who needs to hear it. Let's get financially smart together. See you in the next episode.